Welcome to the Explainer. So today we're going to completely transform how you view the US tax code, turning it from this frustrating, confusing burden into a strategic toolkit. 59% of Americans say their taxes are just way too high. And honestly, they aren't wrong to feel that way. But the reality is that most of those exact same people are not using the completely legal tools already available to them to reduce their bill. The tax code is literally full of legal ways to pay less, but the burden is entirely on you to go out, find them, and use them. Today, we're fixing that.
Real quick, before we dive into the math, just a brief disclaimer. Everything in this explainer is strictly for educational purposes and is absolutely not tax advice. Tax situations vary wildly from person to person, so you definitely want to consult a licensed CPA or tax professional before making any major tax decisions. Okay, with that out of the way, let's get into it. I want you to meet our example for today, Jennifer. She perfectly captures the situation most folks find themselves in. She's a 34-year-old nurse making $78,000 a year, and every April she files her taxes, sees what she owes, and then spends the next 2 weeks complaining about the IRS. But here's the crazy part. Jennifer has a high-deductible health plan, but no health savings account. She puts $200 a month into a regular, everyday savings account instead of an IRA. And she hasn't bothered to update her W-4 tax form at work in 4 years. If she just used the accounts that the IRS designed specifically to incentivize certain behaviors, she could actually reduce her taxable income by over $11,000 this year. She is losing thousands of dollars simply by ignoring the most basic legal tax strategies. All right, here's our roadmap to lowering your bill today. We're going to hit the tax illusion, the new 2026 deductions, the HSA superpower, the retirement tax hack, 5 hidden deductions, and finally, your W-4 action plan. Let's go.
Section 1. The tax illusion. Marginal versus effective. We really have to start by diagnosing a major misconception out there, and that is the difference between your marginal and your effective tax rate. You see, the U.S. uses a progressive tax system. What that means is, if you look at the 2026 tax brackets, you do not pay your absolute highest tax rate on every single dollar you earn. If Jennifer makes $78,000, she falls into the 22% tax bracket, but she's absolutely not paying 22% on her entire salary. It's more like a staircase. She pays 10% on the first block of income, 12% on the next block, and she only pays that 22% rate on the money she makes above $48,475. So while her top marginal rate is 22%, her actual effective everyday average tax rate is much, much lower, closer to 14 or 15%. So the crucial point here is that before the IRS even calculates a single dollar of tax, you get a massive upfront discount called the standard deduction. For 2026, single filers get a $16,100 standard deduction. So Jennifer's $78,000 income immediately plummets down to $61,900 of taxable income. Her effective tax rate is calculated on that much lower number, and if we use the tools we're about to cover, we can push it down even further.
Section 2. New 2026 tax deductions. Claim what you're owed.
We're going to look at the new 2026 deductions from some recent legislation that honestly most people are completely unaware of and are leaving totally unclaimed. First up, tipped workers and hourly employees. Pay close attention to this one. For 2026, qualified tip income and compensation from overtime pay are now deductible for eligible taxpayers, though it does phase out for higher earners. If you work in food service, maybe you drive for a rideshare, or you regularly earn overtime, keeping meticulous records could allow you to deduct up to $10,000 in income. At the 22% tax bracket, claiming $10,000 in these new eligible deductions could immediately save you $2,200 in cold, hard cash. Similarly, did you happen to finance a car recently? Well, you can now deduct up to $10,000 in annual interest paid on a loan for a new personal use passenger vehicle. If you're paying, say, 7% interest on a $40,000 car loan, that's roughly $2,700 in interest the first year alone. Deducting that at a 22% bracket puts almost $600 straight back into your pocket. Guys, it is real money that you are entitled to. And if you are 65 or older with an income under $75,000, there is a brand new, absolute free money senior deduction of $6,000. And yes, this is in addition to the standard deduction. If you qualify, you absolutely must make sure your tax preparer knows about this. A single filer at 65 can now shield a staggering $22,100 of their income from federal taxes entirely. Finally, the new charitable deduction for non-itemizers.
Previously, if you took the standard deduction, you basically got zero tax benefit for giving to charity. Well, now you can claim up to $1,000 in cash contributions or $2,000 if you file jointly directly on your tax return. If you gave $1,000 to charity last year and didn't know this, you literally left a $220 deduction just sitting right there on the table.
Section 3. The HSA Superpower. Triple Tax Advantage. Let's explore what I would honestly argue is the single most underused tax tool in America. If you have a high-deductible health plan, you likely qualify for a health savings account, or HSA. It is the ultimate legal cheat code, offering a triple tax advantage. Step 1, money goes in tax-free, lowering your taxable income dollar for dollar. Step 2, the money grows tax-free when you invest it. Step 3, it comes out tax-free when used for qualified medical expenses. Literally no other account does this. And the hidden superpower? After age 65, you can actually withdraw those funds for any non-medical reason and just pay normal income tax on it, which effectively turns it into a traditional IRA. I mean, that is a highly compelling case for spending 15 minutes doing the paperwork to open one.
Section 4, the Retirement Tax Hack. Lower taxes today.
Let's see how traditional 401k and IRA contributions act as an immediate tax reduction tool, not just a savings vehicle for the distant future. Every dollar you put into a traditional 401k or IRA reduces your taxable income by $1. Look at Jennifer again. Her taxable income was $61,900. By simply redirecting $10,000 of her salary right into her 401k, her taxable income instantly drops to $51,900. She didn't earn less money. She didn't work fewer hours. She just redirected her money, and the IRS immediately rewarded her by knocking roughly $2,200 off her tax bill today. Boom.
Section 5. 5 hidden tax deductions. 5 deductions you missed.
Beyond the major accounts and those brand new 2026 deductions, there are highly specific, incredibly valuable deductions that consistently slip right through the cracks for everyday Americans. Make sure you aren't missing these 5. First, student loan interest. You can actually deduct up to $2,500 of interest paid, even if you don't itemize. Second, the self-employment tax. Freelancers and gig workers, you can deduct half of your 15.3% self-employment tax. Third, the child and dependent care credit. If your childcare costs exceed your FSA limit, you can claim the excess for a massive credit. Fourth, the savers credit. Low to moderate income workers get a credit just for putting money in retirement, which stacks right on top of the deduction you already got. And fifth, the home office deduction, a simplified $5 per square foot for a dedicated workspace. These are entirely legal reductions just waiting to be claimed. Section 6, the W-4 Action Plan. Fix your paycheck. Okay, we've covered the math and the rules, but how do you actually get this money into your paycheck right now instead of waiting until next April? Listen, overpaying your taxes all year just to get a refund is basically giving the government an interest-free loan. Don't do it. Follow these exact steps today. Step 1, go to irs.gov/W4app and use the tax withholding estimator. Step 2, plug in your income, your retirement contributions, and those new 2026 deductions you qualify for. Step 3, the tool will tell you exactly how to fill out a new W-4 form. Submit that to your HR department and instantly increase your take-home pay on your very next paycheck. Get your money working for you right now. So here's what you should really take away from this explainer. The IRS is never, ever going to send you a letter reminding you to claim these deductions. The burden is completely on you to optimize your strategy. I'd love to know what you learned today, so please drop a comment telling us which of these deductions was completely new to you. And hey, if you found this explainer valuable, make sure to hit that like button, share it with a friend who always complains about taxes, and subscribe to the explainer for more structured financial strategies to master your money. I'll see you next time.